Welcome, everybody. I'm John Nersesian. Thank you for spending some time with us today to discuss some potentially relevant year-end financial planning strategies, concepts that you may discuss with your financial advisor between now and December 31. We're going to discuss the potential recognition of capital gains and losses in our investment portfolios as a way of saving current tax dollars, rebalancing portfolios, a disciplined approach to instilling a quality investment management program. We'll discuss the funding of retirement accounts as a way of not only building our retirement preparedness, but potentially lowering our taxable income in the current tax year. We'll examine the concept of annual giving, a way of removing assets from our taxable estates and transferring these assets to intended beneficiaries. And then we'll conclude by introducing the concept of charitable giving as a way of providing benefit to those who might be less fortunate and a potential tax deduction that we can take advantage of in the current taxable year. Let's get started. The first strategy is to recognize, where appropriate, capital gains and losses. We realize that long-term capital property is taxed at a more preferential rate. 0% rate for income up to about $90,000, a 15% rate up to $550,000, and the maximum capital gain rate of an attractive 20%. Now, in addition to these statutory rates, we also have two other rates that clients should be aware of. The ACA taxes, instituted about 10 years ago, the 0.9% rate on earned income, and an incremental 3.8% on passive activities, including the recognition of short-term and long-term capital gains. The process of realizing gains and losses in our portfolios can help to save us current taxes. We know that the recognition of losses in our portfolios can be used to offset realized gains on a dollar-for-dollar basis. Any losses in excess of the realized gain amount can be carried forward indefinitely. The second strategy that we'd like to discuss is the idea of portfolio rebalancing. We all start our investment approach with an intended asset allocation that fits our objectives and our other constraints. But what happens when market performance begins to shift and our portfolio allocations begin to deviate from our intended policy? Portfolio rebalancing is the idea of bringing our portfolio allocations back in line with our original intentions. Rebalancing forces us to do what's typically emotionally difficult, but financially productive. Rebalancing ensures a sense of discipline in a very complex investment management landscape, and it has a tendency to potentially lower our volatility and to enhance our returns. To illustrate, let's take a look at a hypothetical example going back to the year 2008 and 2009. Many of you remember that to be a very volatile period in the equity markets. You can see a hypothetical portfolio of $1 million back in January of 2008, a 70-30 mix between equities and fixed income. Take a look at the returns in the middle of the slide. Performance during the year was very challenging. Most risk assets declined by over 30% or more. We can see the resulting balance at the end of the year given these market returns. What started as a $1 million portfolio declined to approximately $750,000, a 25% overall decline in our portfolio. But just as importantly, look at the shift in the mix of assets. We are now at the end of the year, given these divergent returns, overweight fixed income and underweight equities. So I ask a rhetorical question. After enduring such significant drawdown, how many investors were interested in buying more equities, in reallocating their portfolios to an asset class that had generated such disappointing results over the prior 12 months? A rebalancing methodology would have ensured a disciplined approach to our portfolio structures and would have potentially increased our returns during the subsequent rebound. Our next strategy is to fund retirement accounts. We realize that there are a variety of different ways that we can do this. Traditional IRAs and Roth IRAs have a maximum contribution limit of $6,500. Of course, please recognize that only under certain AGI limitations do we receive an income tax deduction for our IRA contributions, and Roth contributions are also subject to similar AGI limitations. For those of us who participate in employer-sponsored plans, the good news is that the amount to contribute in a given year is $22,500, often through automatic payroll deductions. And for those of us over the age of 50, there's an incremental opportunity to contribute an additional $7,500 as a way of catching up in our retirement preparedness. For the self-employed individuals, there are even greater opportunities to save. Sub-contribution limits today are over $60,000, and for those who want to be even more aggressive with their retirement funding, individuals can consider a defined benefit program which may afford the opportunity to contribute hundreds of thousands of dollars to our retirement accounts. In most instances, these retirement account contributions serve not only to build our retirement nest egg, but to lower our taxable income, saving us tax dollars in the current tax year. Our final strategy is to consider annual gifting among family members or other intended beneficiaries. The annual gift exclusion for 2023 is $17,000 per donor per recipient. So a husband and wife who hypothetically want to support their children or their grandchildren can give up to $34,000 in a single calendar year to an unlimited number of recipients. This premise of making an annual gift helps to lower our estate tax liability in the future and may potentially transfer any appreciation out of our taxable estate as well. Many families leverage the annual gifting that they do by using these dollars to contribute to 529 plans as a way of providing a tax-sheltered way to increase dollars for future educational needs. Our final year-end strategy is to consider funding our charitable giving. We know that annual giving in the year 2022 reached almost $500 billion here in the United States. So we know that many individuals are expressing their charity by giving money or property directly to intended recipients. There's a number of reasons as to why we as a country remain so philanthropically inclined. It's this opportunity, of course, to provide assistance to those who are less fortunate. It's the idea that charitable gifts are one of the few itemized deductions that are still available to us in the tax code. It's also this idea that charitable giving may provide an intended tax benefit in the year of the completed gift. We encourage you to have a conversation with your financial advisors around the most effective way to fulfill your giving, the type of property to be given, the timing of your gift, and the amount of your gift. To consider a variety of different strategies, for the most simplistic of giving cash to the most complex, including split interest vehicles or maybe even private foundations. We hope that you've learned something from our conversation today, and we encourage you to speak with your financial advisor for additional consideration of these valuable strategies.